Derek and Sam are sitting in the same pediatrics waiting room, 6 weeks apart, holding two brand new babies, thinking the exact same thought every new parent thinks in that first sleepless month. If something happens to me, what happens to them? Derek calls an insurance agent that weekend. Sam does too. Neither of them has ever thought about life insurance before in their entire adult lives. And suddenly, at 3 a.m, with a baby finally asleep on their chest, it feels like the single most urgent decision either of them has ever made. They both hang up the phone feeling like responsible adults for the first time in their lives. Problem solved. Family protected. $500,000, just in case. Except they didn't buy the same thing. Not even close. And 30 years from now, the gap between what they actually built is going to be one of the strangest numbers in this whole video, though maybe not for the reason you're expecting. Let's set this up completely fair. Derek and Sam are both 32 years old, both healthy, non-smokers, both earning around $58,000 a year. Both want the exact same thing. $500,000 protecting their family if the worst happens. Same age, same health, same coverage amount. The only difference is which box they checked on the application. Derek's agent walks him through whole life insurance. Coverage for his entire life, guaranteed. Premiums that never increase. And a cash value account that quietly builds up the whole time he's paying in. It sounds like the grown-up choice, a policy that actually builds something, instead of just evaporating if he doesn't die on schedule. Sam's quote looks almost embarrassing next to that. Same $500,000 in coverage, a 30-year level-term policy. His premium comes out to $31 a month. Derek's premium for the identical $500,000 payout, $460 a month. Read that again. Derek is paying almost 15 times more than Sam for the exact same death benefit. And that ratio isn't some outlier quote from one bad agent. Rate data polled across major carriers puts whole life consistently at 10 to 15 times the cost of term for equivalent coverage. Sam feels like he got away with something. Derek feels like he did the responsible thing. And for the first few years, nothing about the math disagrees with either one of them. Here's the part that actually explains why Derek made this choice in the first place, and it's not because he's bad with money. According to research cited by the Zebras insurance data team, roughly 9 out of 10 young adults overestimate what a term policy actually costs, in some cases badly enough that they assume real coverage is out of reach entirely. So when an agent sits across from a nervous new parent and says, for a little more, you get coverage that never expires and builds cash value, it doesn't sound like a sales pitch. It sounds like the only responsible option on the table, because the cheap option never got properly explained. Here's what nobody explains at the kitchen table when you're signing these forms. Derek's $429 premium gap isn't just going toward extra safety. It's going somewhere very specific. And what Sam does with that exact same amount of money is what this entire video is actually about. Sam takes the difference, $429 every month, the gap between what he's paying and what Derek's paying, and puts it into a low-cost index fund, averaging around 9% a year over the long run, which is roughly in line with the market's long-term historical average. Year 1, Sam's little side account is sitting at about $5,400. Derek's whole life policy, at the same point, has a cash value of basically zero. That's not a mistake in this script. That's how whole life insurance is actually built. The bulk of your premium in year 1 goes toward the agent's commission and the insurer's cost of setting up the policy, not toward the cash value column. Multiple industry sources on policy lapse rates confirm this is standard structure, not a shady exception. By year 3, Sam's account has grown to around $17,700. Derek's cash value has finally started moving, sitting around $3,500. Meanwhile, Derek has paid in over $16,000 in premiums by this point. Sam has paid just over $1,100. Here's a number that should genuinely bother you if you're the one holding a whole life policy right now. According to a 2009 industry report from LIMRA, close to 12% of whole life policies lapse in the very first year. Another 10% lapse in year 2. That means by year 2, roughly 1 in 5 people who bought exactly what Derek bought have already walked away from it, and in most of those cases, walked away with next to nothing to show for it. Why would an insurance company design a product this way? Because they're not betting on you dying. They're betting on you quitting. A 2021 academic study published in the American Economic Review found that 57% of permanent life insurance policies lapse within the first 10 years. More than half. The company profits enormously off the people who front-load years of premiums into a policy and then walk away before the cash value ever catches up. By year 5, Sam's account is at roughly $32,300. Derek's cash value has crept up to around $10,000. Derek has now paid $27,600 total into his policy. His account is worth $10,000 of it. If Derek quit today, he would have handed the insurance company almost $18,000 for absolutely nothing. By year 10, Sam has crossed $83,000. Derek's cash value sits around $40,000. Derek has paid in $55,200 by now. His policy is still worth less than what he's put into it. Let that sink in for a second. 10 years in, a full decade of payments, and Derek's supposedly safe asset is still underwater relative to what he spent. At a barbecue, none of this shows up. Derek talks about his policy that builds equity. Sam just says he's got some term insurance and an index fund, and the conversation moves on. Nobody's impressed by Sam's answer. There's no product to show off, no agent who called him smart for buying it. But feelings don't show up on a balance sheet, and neither does a good sales pitch. You might be thinking, sure, but that math only works if Sam actually invests the difference instead of spending it on something else. And that's a completely fair objection. The entire buy term and invest the difference strategy collapses the moment the second half doesn't happen. This isn't a plan for someone who's going to blow that $429 a month on dinners out. It only works for someone who treats the investing part as non-negotiable as the premium itself. There's also a number the whole life industry loves to advertise, and it's worth addressing directly. Mutual insurers like Penn Mutual have paid dividends as high as 6% in recent years, and agents will point to that figure as proof the policy is quietly outperforming. Here's the catch nobody clarifies. That 6% is the dividend credited on top of the base policy, not the actual return you personally realize once you account for the fees, the front-loaded costs, and everything Derek lost in those first 10 years just getting to break even. Run the real numbers end to end, and Derek's actual effective growth rate on his own money lands closer to 3% by year 30. Real, but nowhere near what that headline dividend number implies. Now, if I stop the video right here, I'd be doing exactly what every anti-whole life YouTuber on this platform does, making it look like a scam and calling it a day. But that's not honest, and it's not the whole picture. So let's actually be fair to Derek for a minute. By year 15, Derek's cash value finally crosses over what he's paid in. It's sitting around $90,000 against $82,800 in total premiums. From this point forward, every year genuinely does make his policy look better than the year before. Whole life isn't designed to reward you early. It's designed to reward patience, decade after decade, the same way a fruit tree does nothing for years and then quietly feeds you for the rest of your life. And whole life does have one thing term insurance can never offer: a guarantee that survives you getting sick. If Derek develops diabetes at 50 or has a heart scare at 60, none of that matters. His premium was locked in the day he signed. His coverage cannot be canceled, repriced, or denied. That guarantee is real, and for certain people, it's worth paying for. Picture a version of this story where Derek and his wife have a child with a lifelong disability, one who will need financial support long after Derek is gone, not just until age 18. A 30-year term policy doesn't cover that. It can't. The need never expires, so a policy that also never expires stops being a luxury and starts being the only tool that actually matches the problem. The same logic applies to certain estate planning situations, where a guaranteed payout is needed to cover taxes on assets that can't easily be sold. Whole life isn't a bad product, it's a specific tool being sold to a general audience that mostly doesn't need it. By year 20, Sam's portfolio has grown to roughly $286,500. Derek's cash value is around $140,000. The gap is real, and it's growing, but Derek does now have something to point to. By year 25, Sam is sitting close to $481,000. Derek's policy has grown to around $200,000 in cash value, on top of that same $500,000 death benefit that has never once been at risk, not for a single day, regardless of what the stock market did in any of those 25 years. Now here's where the story gets genuinely interesting, and it's the part almost nobody puts in these videos. At year 30, Sam's portfolio has grown to $785,389. Derek's cash value sits around $277,500. On paper, Sam is ahead by more than $500,000. $500,000 gap for putting the exact same amount of money to work. But year 30 is also the exact year Sam's term policy expires. Sam is 62 years old. His $500,000 death benefit, the thing this entire plan was originally built to protect, is gone. Finished. If he wants new coverage at 62, he's not getting his 32-year-old rate anymore. He's shopping in a completely different market as an older applicant, and if anything has changed with his health in 3 decades, he may not be able to buy meaningful coverage at any price. Derek's $500,000 is still sitting there, fully intact, guaranteed, whether he dies at 63 or 93. If Sam wants to replace even a fraction of that protection at 62, he's no longer the healthy 32-year-old getting the cheapest rate on the market. A new term policy at that age, assuming he still qualifies at all, can easily run several times what Derek is paying for permanent coverage, for a policy that itself will expire again in another 10 or 15 years. Sam isn't just facing a higher price, he's facing the same cliff a second time, just closer to the edge. Call this the coverage cliff. It's the moment a term policy simply stops existing, at exactly the age when new insurance becomes most expensive or most difficult to qualify for at all. Nobody explains this part when they're 29 years old signing paperwork for the cheapest possible premium. And it's the single biggest piece of information missing from almost every Buy Term and Invest the Difference video on this entire platform. So, which one actually wins? Here's the honest answer, and it's not the exciting one. For most people in Derek and Sam's exact situation, term life insurance really is the better tool for exactly as long as the need is temporary. Raising kids until they're independent, paying off a mortgage, covering the years where losing an income would be catastrophic. According to LIMRA's own 2024 sales data, whole life still captures about 36% of new premium dollars in this country, nearly double term's 19%, largely because agents earn dramatically higher commissions selling it, not because the math favors it for the average family. But buy term and invest the difference only works if you actually do the second half of that sentence. And here's a detail almost nobody mentions. Most term policies include something called a conversion rider. It lets you convert some or all of your coverage into a permanent policy later, without a new medical exam, usually within the first 10 years or before a certain age. If Sam's health changes at 50, that conversion option is sitting right there in his existing contract, completely unused, because nobody ever told him to look for it. The actual smartest structure isn't picking a side. It's buying term for the years you genuinely need a large death benefit, actually investing every dollar you save doing it, and keeping an eye on that conversion window before it closes so you're never standing at 62 with a portfolio and zero protection at the exact moment your health might work against you. So the next time somebody tells you whole life insurance is a scam, or that term insurance is a waste of money because it expires worthless, don't argue with them. Just ask them one question. What happens the day the policy ends? Because that's the only question that actually tells you which one you're holding.